one of the things that we're trying to focus our conversations with investors on is not that the tech sector will sell off in its entirety, but a very clear recognition that the segments that have run the farthest and the fastest are at risk. Now, that's not to say that we don't see signs of demand in certain subsectors. And so if we look at PCs as an example, the share prices are not baking in an extension of work from home into 2021. So we see that as an opportunity. Gaming equipment demand remains very strong. Chromebooks, as an example, driven by education demand, continue to be quite strong. And so we see very significant rotational trades at play within tech rather than a recovery for the overall tech sector.
Right. Many analysts have been telling us that this is a buy on dips move for technology. But the question is, do you buy now after this 10% scale back nearly, or do you wait it out a bit? How do you time getting back into the markets?
So we would conceptualize the answer to that question slightly differently. It wouldn't be a broader buy on dips, buy whatever's gone down the most. It's really focused on where is the incremental source of surprise. And if I look at the incremental demand curves for data centers, if I look at the incremental demand curves for some of the high flying portions of the tech sector, there are no obvious catalysts for the next 6 months. In particular, if you look at elements of the semiconductor ecosystem, you've seen very large players build up massive inventories in many instances on the back of regulatory risk. So we don't see positive catalysts for those sectors. And so again, we'd be far more focused on a rotational trade rather than a buy the dip strategy.
And what looks most attractive to you if you, let's say, have cash in the sidelines or were lucky enough to rotate out of tech before this dip? Where do you want to put the money?
So we'd be primarily focused in PCs, gaming consoles, Chromebooks, incremental sources where we see demand. The smartphone cycle is an interesting conversation to have. We've seen severe underperformance of Apple iPhone supply chain stocks, primarily in Taiwan, due to a perceived loss of competitiveness relative to some of their Chinese competitors. We do think those stocks perform well given the increase in volume expectations for overall iPhone shipments as we move through the second half. So again, very clear signs of demand exceeding expectations for subsegments of the overall ecosystems, but not overall.
And as we look in parts of the world and wonder when value becomes a real theme, I mean, you've pointed out based on some of the data you track that the cyclical versus defensive play is actually working in China. Does this continue to be the story?
We do think that will be the case. We run a series of high-frequency data analysis through a report series called the Show and Tell series. We track over 300 different data sets on an Asia-wide basis to try to understand on a relatively live basis what's going on the ground. We are seeing a significant improvement in overall activity data. We are seeing a situation in China where we do think the cyclical outperformance will extend. One of the core things that we're focused on, however, is an expectation versus reality conversation. And that's absolutely critical. If I look at the US market right now, 75% of US companies have beat expectations, despite the fact that they're delivering negative 33% EPS growth. And so it's very, very important to understand where the bar has been set by the expectation side of the conversation.